Hello, everybody. My name is Natalie Colley. I am a lead advisor here at Francis Financial, coming to you with April's Investment Insights. Each month, we put together this Investment Insights presentation to cut through the noise and tell you what is important to focus on in the market for your portfolio, for your own peace of mind. So let's dive right in. Whew, there's no tiptoeing around the fact that the first quarter of the year was pretty rough in the markets. As though COVID and its numerous variants weren't enough, we have high inflation that we are now dealing with, the Fed talking about aggressively raising interest rates, potentially to send the economy into a recession. And then on top of all of that, the Russia-Ukraine war. It's a lot. It's a lot to deal with, and it's reflected in what we're seeing here, read across every single asset class. The market likes to predict what's going to happen in the future, likes to feel like it knows. Right now, there are a lot of variables that are throwing that into uncertainty, and that's being reflected. Something historic about the returns of the first quarter, or not historic, but rare, definitely rare. The US bond market was down almost 6%, which is even worse performance than the S&P 500. The US stock market was down only about 5.3%. So that almost adds insult to injury. You have bonds in your portfolio to add stability, and over the long term, absolutely, that's what they do. But the first quarter of this year, that is not what we saw. Unfortunately, it was the worst quarter for a US bond market on history, down again, almost 6%. So what's an investor to do at this point? Well, there are a few things. The first, let's try to make some lemonade out of lemons that we have here. Harvest losses. This is an easy thing to go to if you have a large taxable portfolio and you're paying capital gains tax because of the trades that you place in that portfolio each year. Well, now is a great time to look into whether it makes sense to place some strategic trades that can harvest losses that you can then use to offset future gains and lower that tax bill. So that's number one. Number two, make extra sure that you are in the best funds within your portfolio. Now, what we typically see is when the market has been moving up and sort of just chugging along like we've seen the last 2 years, it's been doing excellent. Investors tend to become complacent and just assume that their portfolio is working as hard as it possibly can for them. Now, our clients have us, and we are constantly looking at this in the background. We have an investment committee that meets every single month. We turn over every single one of these funds, leaving no stone unturned to make sure that you have the most robust portfolio possible. And last year was no exception. This year is no exception. We're continuing to do so. And the third is one of the most simple concepts in investing, can also be the hardest for an investor. And that is to really just stick with it and keep that long-term mentality. What I love about this particular page, at the very bottom, you see the worst quarter, and pay attention in particular to the years. See 2008, the great financial crisis, 2020, COVID, 2008, again, the great financial crisis, 2008. These are years that we remember for obvious reasons. The great financial crisis, no one can forget that. 2020 COVID, obviously, that was only 2 years ago. You're not going to forget that. What I love about this is look at the next row up, the best quarter. Pay attention to those years. 2020, COVID, 2009, right after the great financial crisis, 2009, 2001. And what this tells me, and why this should give investors hope, is that after historic downturns in the market, we very quickly thereafter see historic upswings as well. So that's why it's so important to maintain your stance, to stay invested in your portfolio, because we know right now what we're seeing is a really nasty downturn. And we also know from history that these are followed by really, really good market performance. and we can't afford to miss that market performance. Now, we don't know if it will be next quarter or this year, maybe in 2023, but we know it's coming and it's important to stay invested and not miss those quarters. To that point, let's zoom out even further. If we look at returns, looking back the last year, the US stock market has still done phenomenally well, up 12, almost 12%. International developed stocks, up 3%. Emerging market stocks, now they have still been hit pretty hard over the last year. They're down 11%. With US bond market as well, given what's going on with interest rate hikes, down about 4%. Let's zoom out even further, the 5-year mark, phenomenal returns across every single asset class, positive. US stock market up 15% each year, developed international up 7%, emerging markets, even though they are down 11% for the 1-year period, emerging markets over the 5-year period up 6% every single year. Great returns. And if we zoom out to 10 years, again, all positive returns. And this just underscores the importance of staying invested for the long term, keeping that long-term investor mentality. Well, we're not just going to leave you with the message that you need to stay invested and not change anything. We also have a little tip for you. Given high inflation and on the subject of making lemonade out of lemons, we bring you I-bonds, an interesting little investment tip for your cash on hand, your emergency fund. Now, I-bonds have been around for a very long time. They're not new. They are offered by the federal government. They, just like any other bond, they have interest that they pay investors, and it's composed of 2 different interest rate pieces. One is a fixed interest rate and the other is tied to inflation. Now, you haven't heard about these for a long, long time because inflation has been stubbornly low. Remember that the Fed was trying everything they could to get inflation up to 2% for a decade or more. Well, now inflation is here, but let's take it and at least get something out of it, right? So I-bonds are right now the top yielding US asset because inflation is so high that they are paying interest rate of almost 9%. On top of that, they carry virtually no risk of principal loss because they are backed by the full faith of the US government, and they offer some tax benefits. Now, you can select to defer interest until the maturity of the bond or until you redeem the bond, and they're not taxable at the state level, only taxable at the federal level. They do have some limitations though, and I want to be clear about what these are. The first is that you can't purchase them in your portfolio. So we can't purchase them for you. You have to go to treasurydirect.gov. You have to set up your own account there, transfer money in. It's a little clunky, but again, offering right around 9% interest, it's worth it. The money that you do use to purchase I-bonds cannot be redeemed for 1 year. It is locked in. So very important to only use money that you know for certain you are not going to need for 1 year. That being said, the annual cap is $10,000 per person. So we're not talking, you can't move hundreds of thousands into these I-bonds, $10,000 per person. But if you're a family of 4, you can buy one. You can buy one for your spouse. You can buy one for each of your children. And then all of a sudden you can put $40,000 into this. The last piece is, like I mentioned, I-bonds weren't anything anyone was talking about for decades because interest or inflation was just so darn low. They were paying next to nothing, and it just didn't make sense. So they're really only such a great deal while inflation remains high. They get reset every 6 months. However, when you purchase an I-bond, your rate is guaranteed and locked in for 6 months from your date of purchase. The next adjustment is the first business day of May. The next adjustment after that is the first business day of November. So always May and November. However, if you buy an I-bond in April, you will be able to take advantage of the current rate, which is amazing, and that will be locked in for 6 months, at which point it will be reset. So as inflation stays high, these are a phenomenal deal. as inflation starts to come down, they become a little bit less of a great deal. The last piece to keep in mind, if you redeem these bonds between 1 and 5 years, you do give up the last 3 months worth of interest. So not a huge deal. We've been telling clients, in your mind, think about holding these bonds for at least a year and 3 months. And then if you redeem it at a year and 3 months, you still get that 1 year of really solid interest. As always, we have an open door policy here at Francis Financial. We love talking to you, love talking about what you're up to, and we love talking about your portfolio. So please do not hesitate to reach out at any time. We're here for you. Take care.